Wealth is rarely just about numbers. Beneath every investment decision lies a complex emotional calculus, fear, hope, and desire intertwined. The psychology of risk and reward defines how empires are built and fortunes lost, often before a single trade is made. Understanding it is the ultimate edge in the modern economy. Our brains were not designed for Wall Street. They were wired for survival on the savannah, where avoiding danger meant staying alive. Yet in finance, the instinct to flee risk can sabotage opportunity, trapping investors in cycles of hesitation and missed chances. True prosperity begins with mastering that primal circuitry. Risk tolerance is less a number on a form and more a reflection of identity. Some thrive on uncertainty, the thrill inspires focus. Others crumble under anxiety, drawn to the illusion of safety that often yields stagnation. To understand risk is to understand oneself, your comfort, your vision, your emotional equilibrium. Every reward story begins with tension, the internal debate between safety and ambition. The investor who leaps without thought becomes reckless, the one who never leaps remains stagnant. True mastery lies in measured action, recognizing that all growth requires discomfort, and every great fortune began with uncertainty. When people talk about money, they often forget it's an emotional mirror. The market's rises and falls aren't personal, yet our responses always are. Emotional awareness converts volatility into opportunity, because while markets reward logic, wealth compounds fastest in those who manage their impulses under pressure. Human behavior skews risk perception dramatically. We overvalue losses and undervalue gains, a phenomenon psychologists call loss aversion. This bias distorts judgment, making a small risk appear catastrophic while a major one seems minimal if framed correctly. Successful investors learn to detach emotion from probability. The wealthy often speak a different emotional language around risk. They see setbacks as tuition, not failure, transforming experiences into data points. This mindset doesn't eliminate danger, it reframes it, showing that failure managed intelligently becomes the most powerful form of experience-driven capital. Consider the gambler's fallacy, the belief that past outcomes influence future results. It seduces investors into irrational timing, convincing them patterns exist where none do. The market, however, owes no symmetry. Rational thinking emerges when we understand randomness not as chaos, but as part of the system's rhythm. Reward is access to possibility. It's what entices us to innovate, to venture beyond limits. Psychological studies show the brain releases dopamine not from the reward itself, but from anticipation. This explains the rush of a startup founder or a stock trader. The thrill lies in pursuit, not possession. Our culture celebrates risk-takers, yet often forgets the silent preparation behind every calculated move. Behind each apparent leap stands analysis, introspection, and resilience. To manage risk doesn't mean avoiding it, it means ensuring that when risk arrives, your foundation, both mental and financial, can withstand it. In behavioral finance, framing effects determine outcome perception. The same data, presented differently, can ignite greed or fear. Wealth builders learn to neutralize these frames, processing numbers with cold precision while others react emotionally. This objectivity transforms volatility into a predictable ecosystem. The human mind often mistakes familiarity for safety. Many invest in what they know, clinging to comfort zones that limit real growth. Yet real wealth lies beyond familiarity, where innovation, adaptation, and intelligent courage reprogram the mind to see the unknown not as a threat but as untapped territory. Some of the greatest opportunities emerge from perceived chaos. Recessions, disruptions, and technological shifts expose inefficiencies and open hidden doors. Those who understand risk psychology anticipate these windows, approaching uncertainty as fertile soil, not quicksand. Courage meets calculus in these moments of transformation. Time dramatically alters our perception of reward. Immediate gratification feels powerful, while delayed reward feels distant. Yet compounding, the quiet multiplier of wealth, rewards those who defer pleasure. The psychological maturity to prioritize long-term over instant wins separates enduring fortunes from fleeting ones. Risk is contagious. Herd behavior drives booms and crashes alike, as collective emotion amplifies volatility. The centered investor recognizes this and steps back when the crowd surges forward blindly. In market psychology, independence isn't isolation, it's self-command amid collective noise. Every great investor wrestles with uncertainty. It's not something eliminated, but managed. Through self-education, diversified thinking, and exposure to varying perspectives, they build confidence rooted in process rather than prediction, a mindset that replaces guessing with disciplined probability. Status and comparison quietly motivate many financial decisions. The desire to outperform peers fuels risk appetite beyond logic. Recognizing this emotional driver neutralizes its power, allowing wealth creation to shift from competition to composition, where one's only benchmark becomes long-term purpose. Cognitive biases like confirmation and anchoring skew judgment. The mind seeks validation of existing beliefs, filtering data selectively. True mastery lies in intellectual humility, the willingness to question assumptions constantly. In finance, that mental flexibility is worth more than any algorithm. Risk and reward form a feedback loop, experience sharpens intuition, and intuition refines decision quality. Over time, this neural muscle memory becomes instinctive wisdom. It's how seasoned professionals appear effortlessly calm while others panic. They've trained their psychology through exposure, not avoidance. History rewards the informed risk-taker. From industrial titans to modern tech pioneers, each breakthrough hinged on managing unknowns. They viewed volatility as a landscape to study, not fear. Their psychological edge wasn't arrogance, but preparation fused with vision, the understanding that discomfort births innovation. Fear of loss carries origins in our earliest evolution, when scarcity meant death. In wealth psychology, confronting that fear is an act of growth. By reframing scarcity into abundance thinking, we create mental resilience that recalibrates perception, turning fear from a warning into a navigational tool. Humans often assume control guarantees outcome, but randomness always has a seat at the table. A sophisticated mindset accepts uncertainty as constant, crafting systems that succeed despite it. This detachment builds consistency, the quiet force behind meaningful and sustainable accumulation. A strong risk psychology transforms crises into laboratories of learning. Instead of asking, "Why me?" the disciplined mind asks, "What next?" That shift in language ignites empowerment, enabling quick recalibration and forward momentum. Emotion managed becomes energy harnessed. The illusion of control seduces high achievers into believing they can outthink chance. Yet real mastery accepts probability's boundaries and operates efficiently within them. The disciplined investor doesn't eliminate risk, they engineer exposure intelligently, ensuring chaos never holds total control. Reward, at its core, is a psychological pattern. The satisfaction of achievement doesn't come solely from money, but from alignment, when intention matches outcome. Purpose-driven goals anchor motivation, ensuring that pursuit of wealth becomes a fulfilling narrative, not a hollow chase. In financial behavior studies, optimism bias causes overconfidence during winning streaks. The antidote is self-auditing, slowing down success to examine its structure. Sustainable reward stems not from excitement but from discipline, transforming what could be temporary luck into repeatable performance. Emotionally intelligent investors understand thresholds. They set predefined points of comfort, removing impulse from execution. It's the psychology of pre-commitment, decisions made in calm that guard against decisions made in chaos. In this, mental architecture becomes as valuable as any financial strategy. Cultural narratives shape our sense of risk. In certain eras, boldness is celebrated, in others, conservatism prevails. The wise mind studies cycles, not just market cycles, but social psychology, recognizing when collective sentiment offers clues about where unseen value, or danger, might reside. Patience often appears passive, yet it's the most active psychological discipline in the financial world. Remaining composed while others react amplifies compounding's magic. Each calm decision adds invisible interest to future opportunity, proving that composure is profit expressed through time. The growth mindset reframes failure from end to feedback. Every setback yields information about your process, risk tolerance, or timing. In the long arc of wealth creation, each lesson compounds emotionally, refining judgment until clarity itself becomes a form of capital. Social proof tempts the inexperienced investor to chase trends. Yet when everyone moves in one direction, asymmetry fades. True opportunity exists on the psychological margins, those areas of discomfort where few dare to look. Wealth gravitates toward those who cultivate calm within collective noise. The psychology of reward teaches us that fulfillment must extend beyond profit metrics. Financial freedom, ultimately, is emotional freedom, the ability to act without fear, choose without constraint, and think without scarcity. A wealthy mind precedes a wealthy portfolio. In the long run, mastery of risk and reward psychology creates agility, the hallmark of enduring prosperity. It fosters calm amid volatility, confidence amid uncertainty, and vision amid noise. Money follows mindset, always. The truly rich are those who understand the human mind's greatest investment is awareness itself. As the world accelerates, the ability to stay centered becomes the ultimate asset. Those who study the invisible drivers of risk and reward shape industries, influence economies, and design their destinies. Because wealth isn't built in the market first, it's built in the mind long before the first dollar moves. In the end, risk and reward are twin forces of growth, fear and hope, forever intertwined. Master them, and you master time itself. Every decision becomes not a gamble, but a strategic expression of understanding. That is the psychology of wealth, where intellect meets courage, and conviction becomes capital.